Hi, and welcome to Federal Appraisal LLC's video series. Today, we will be talking about property tax assessments and history within appraisals. Given that property taxes are among the largest single expenses of ownership, active and proper management of assessments is essential. This management impacts appraisal in two ways. First, property taxes impact many areas of appraisal analysis. Secondly, appraisals written for property tax management and appeals must be written specifically for this purpose and use. Most parcels of real property are subject to ad valorem taxation, or in layman's terms, property taxes. In some states, personal property is also subject to ad valorem taxation. A few properties are exempt for reasons such as the property is owned by a government or it is occupied by public uses such as schools and for non-for-profit activities, or property is specifically exempted for public policy reason, such as economic development or environmental enhancement. Ad valorem is Latin for according to value. Ad valorem tax, or property tax, is a tax based on the value of the property, as opposed to income taxes which are based on rates of income, or sales taxes which are based on sale prices. In order to know if your property taxes are fair, you must know your property's value. Property taxes are typically levied by municipalities or counties. Property taxes are computed from an assessed value and a property tax rate. The assessed value is sometimes referred to as an assessment. The property tax rate is sometimes referred to as a mill rate. A property tax rate is usually expressed as a percentage of value, while a mill rate is usually expressed as a tax dollar amount per $1,000 of property value. As an example, 10 mills is equivalent to 1%. A tax collector administers the application of the tax rate and collection of the taxes. Commonly, the tax rate is set as the financial budget for the taxing jurisdiction divided by the sum of all assessed values. This formula can lead to significant changes in taxes when very large properties, such as refineries or power plants, represent a major portion of a town's taxable property. For example, take a look at the following figures. When the assessed value, and thus the property tax, of a very large property is revised to a significantly lower amount, while the town's budget remains constant, the tax rate for all other properties in the town will rise significantly. Commonly, it is a tax assessor's responsibility to set the assessed values. In some states, for special properties such as utilities, a state agency sets the assessed value. Assessors set the assessment according to the laws and regulations in each jurisdiction and state. It should be noted that the assessment laws and regulations in each jurisdiction and state can vary significantly. Procedures used in one state are frequently inapplicable to those in another. Assessing property may be described as a special type of appraisal or valuation practice. Sometimes, special appraisal methodologies and definitions are employed, as required by local law and regulation. Sometimes, mass appraisal techniques are employed. For example, appraisal procedures used in property tax assessment are frequently inapplicable to appraisal procedures used for financing, accounting, or income tax appraisal. The assessed value is typically defined as value multiplied by an assessment ratio, where value is commonly taken to mean market value. However, in some jurisdictions and some important circumstances, the definition of this value departs from the definition for market value found in other appraisal contexts, such as financing, accounting, or income tax appraisal. A more in-depth discussion of the meaning of market value can be found in another of our videos, which is linked below. Sometimes, the assessment ratio is known as an equalization ratio or rate. Assessed value is not always equal to market value. In market value jurisdiction with a 75% assessment ratio, the assessed value will be lower than market value. Let us reiterate that it is the assessor's job to estimate the value that is converted in an assessed value as per local law and regulations. Typically, the assessor determines market value and then applies the assessment ratio to find the assessed value, on which the tax collector applies the tax rate to compute and collect the taxes. For example, if the appraised market value of a property is $5 million and the assessment ratio is 80%, the assessed value will be 80% of $5 million, or $4 million. Then the 2% tax rate is applied to arrive at an $80,000 property tax. Some appraisers find it useful to combine the assessment ratio with the tax rate into what they call the effective property tax rate. The effective property tax rate is useful in several appraisal procedures such as estimating net income and cash flows, or estimating capitalization rates and discount rates, and for comparing taxes in different jurisdictions. In this example, the assessment ratio and tax rate are multiplied together to arrive at an effective tax rate of 1.6% of market value. Generally, when working on an appraisal for reasons other than property tax assessment, such as financing, accounting, or income tax appraisal, appraisers will include information about a property's assessment for 3 reasons. First, the appraiser may find the information useful in several appraisal procedures, such as estimating net income, cash flows, capitalization rates and discount rates, and for comparing different jurisdictions. A property tax information is essential even in appraisals written for financing, accounting, or income tax reporting purposes, since an improper tax assessment will lead to improper property tax payments, which will impact cash flows. Secondly, some users of appraisals believe that assessors' opinions about a property and its value are probative to an appraisal under consideration for these other purposes, such as financing, accounting, or income taxes. However, we note that this probity has important limitations given that these other purposes usually mandate such different appraisal practices and procedures. Thirdly, sometimes a property can be overassessed or underassessed. Assessing departments are often understaffed and improper assessments occur regularly. For this reason, appraisers sometimes need to analyze assessments to determine a property tax load for net income and cash flows estimates, and for computing tax rates and discount rates in an income approach analysis, and for comparison purposes. Besides writing an appraisal for other reasons, such as financing, accounting, or income tax reporting purposes, an appraisal may be written to aid in setting the assessment of a property. Such property tax appraisal can be written by and for an assessor, but they can also be written for the property owner. Property owners hold the right to appeal their assessments, but only through a rigorous appeal process, which includes an appraisal written specifically for this purpose. Here at Federal Appraisal, we have dealt with hundreds of tax appeal cases on behalf of both taxing jurisdictions and property owners. Whether by or on behalf of an assessor or property owner, and whether to set or to appeal an assessment, an appraisal for property taxation must be completed according to specific circumstances of the case, according to local law and regulations, and according to best appraisal practices. The diversity of circumstances and of that appraisal practice preclude further meaningful prescriptions in this video. For example, it is impossible to establish whether only 1, 2, or all 3 approaches to value are required for any particular property type, or location, or time frame for a property assessment appraisal without first completing an expert appraisal investigation of the circumstances. Make sure to like and subscribe to our channel for more exclusive appraisal content.